Hi, I'm Alex, welcome to the channel and thanks for tuning in. Now recently I've seen loads of excitement within the market that penny stocks are the future for 2022 and that amazing returns will be generated for all investors in penny stocks. Even some mentioning that it's the turn of penny stocks. Sadly, that's just not how the stock market works. Personally, I'm less supportive of this thesis and belief, and I think a good handful of penny stocks could be in for a really tough ride in 2022. In this video, we're going to discuss why I think this, and most importantly, how we as investors can avoid these higher risk areas and make better returns across our portfolio. Before we get into it, smash the like button, subscribe to the channel, and check out the Patreon group for the private Discord. Whilst my full-time actual job is investing, I'm not a financial advisor. This video is solely for entertainment and educational purposes only, but let's get straight into it. So I think penny stocks can very broadly be bucketed into four main categories. These are great, fully operational companies that are likely to cease being penny stocks as they grow. Penny stocks that will always remain penny stocks. They have been one for many years, and their growth potential or the addressable market doesn't support much more growth. Pre-revenue companies that may or not become commercially successful and commercially viable. And finally, previously larger successful companies which have fallen out of favour and have got smaller. Each of these has their own discrete challenges, and we'll go through each of these in turn and discuss the likely fortunes of these for 2022 and beyond. Now clearly the two categories which most people get most excited about are the highest growth potential ones, whether that's pre-revenue or small scale revenues, or alternatively the companies destined to continue their consistent growth. These will be our focus for today, but let's quickly touch on the challenges that these under penny stocks may face. Penny stocks that have very limited growth potential and are destined to remain listed as penny stocks are likely to be hard hit in the market during 2022. We've seen record capital inflows into the stock market during 2021. Said differently, investors have invested more money in the stock market during 2021 than ever before. With the ending of quantitative easing and increasing interest rates, there's likely to be capital outflows or money taken out from the stock market. The result of this is that penny stocks broadly will be impacted, but some less than others. The same is true for once much larger companies which are now penny stocks. There must be a reason for this decrease in valuation, whether that's due to a strategic mistake or a change in the market dynamics, or perhaps just a loss of market share. These companies will also be hard hit during 2022 and under these circumstances. Additionally, in situations like this, investors should be particularly cautious that they're not just catching a falling knife here. Clearly, there could be some diamonds amongst the rough here, but that is the exception, not the rule, and I leave that meticulous DD that's required to define those to the deep value investors. So now let's focus on the growing companies that are fully operational but delivering consistent year-on-year growth. Personally, this is where I'm going to be most focused on within my penny stock investing. While valuations may be hit by the previously mentioned dynamics, the likelihood is that these companies are sufficiently cash generative that any reduction in stock price should not affect the actual delivery of its strategy. The strategy here is for investors to ascertain whether you are a long-term investor and prepared to be able to wait for this company to deliver on its growth strategy and its valuation potential or not. If the former, then that's not a problem. If the latter, then maybe you should consider exiting your position sooner rather than later. Clearly, there are some nuances to this. Say the company is delivering an acquisition-led growth strategy that is done through an entirely equity-led purchases. Said differently, it buys the companies with its own shares rather than cash. Then in that situation, a lower stock price means they have to give away more shares, which is slightly more dilutive for the existing shareholders. That aside, these are an area I see as being the safest section of the penny stock market currently. Now the final category of penny stocks to touch on are those which are not yet generating revenues, or if they are, they're very, very negligible and minimal. These are companies that have established cost bases, which means they're losing money and burning cash. The result of this is that to stay solvent and not go bankrupt, these stocks will need to raise cash through another method. Typically this is through selling their own shares to new investors and the company doing an equity raise, which results in the company generating cash and its existing investors becoming diluted. This is the category which actually over the last year has probably had the greatest interest from retail investors and the category which has benefited from the greatest capital inflows and greatest stock price run-ups. This in turn means a greater potential to fall and also has the greatest degree of execution risk, as perfect strategy execution is pretty much priced into all of these stocks. The more the stock price falls, not only the more shares have to be sold and in turn the existing shareholders diluted by a larger amount, but it also actually may result in a situation where it's harder to find investors to buy those shares, which in a worst case scenario could even lead to the company becoming bankrupt and being unable to pay its expenses. Now a slight digression here is around SPACs, which have fallen out of favour massively recently. But actually this is where the market has a bit wrong, and so we'll cover this in more detail in its own separate video. But these SPACs are already diluted on day one, and there isn't that same risk at all. The market does seem to have missed this slightly, and it doesn't even take a deep value investor to spend too much time to understand this and to recognise this dynamic. Now there's too much to discuss here for one video, so I'll come back to that in another one, but it's definitely worth the discussion for serious investors looking to generate long-term consistent returns from their investments. Now in summary, I think investors need to be really careful around penny stocks, as I don't think the whole sector will be the riches that many people on YouTube are claiming it will be. Yes, there will be some great opportunities, but I also firmly believe there'll be quite a lot of big losses and sustained losses too. So act with real caution and diligence in this market. Anyway, that's it for this video. I hope you enjoyed it. Thanks a lot for watching. If you did enjoy it, please smash the like button. If you're new to the channel, make sure you're subscribed and check out the Patreon for more investing related content. As always, please let me know your thoughts and comments in the comment section below. I find it so interesting to hear the different opinions and perspectives, so please get involved. Thanks again for watching, and I'll see you in another video.